Hi, this is Adam Khoo here, and today I'm going to share with you the most important secret to successful investing. You guys ready? So the most important ingredient to achieving consistent profits in investing is to buy low and sell high, is to buy cheap and sell expensive. Now I know some of you are looking at me right now and thinking, yeah, you're a genius. Of course I know that. But it's easier said than done. Like, how do I know when something's cheap? And how do I know when something's expensive? Because sometimes looking at the absolute price can be very misleading. For example, let's take a look at two stocks right now. Robinhood, ticker symbol HOOD, and Meta Platforms. Robinhood is currently selling at $19 per share. And Meta Platforms is selling at $467 per share. So which stock is cheaper and which is more expensive? Now, most amateur investors will say, of course this is cheaper, it's only 19 bucks. This is so expensive, $467. It's gone up so much ever since the last 2 years. Well, wrong. I'm going to prove to you in this video that in fact, Robinhood at $19 is expensive. And Meta Platforms at $467 is still dirt cheap. Why? Because the absolute price means nothing unless you know what is the intrinsic value of the stock and then base the current share price on that intrinsic value. So this was a lesson I learned many years ago, over 16 years ago, when I was not as smart as I am today, right? So many years ago, I remember that I bought this stock from the Singapore Stock Exchange. It was called L&M. It was a construction company that was selling at 3 Singapore cents. Now, why did I buy this stock? Because it looked so cheap. I said, 3 cents, how low can it go? And at the same time, I remember at a point of time, Google, listed on the US exchange, was selling at $200 per share. Now, it so happened that I bought both stocks, but at that time, I thought that this was cheaper, it would go up even more, whereas Google looked a bit expensive. I was a bit uncertain. But over a year later, L&M from 3 cents dropped to 0. It went bankrupt and I lost all my money. Thankfully, it was not a lot of money. And Google, which I also bought, from $200 went up to $1,000 a share and continued to go up for the next couple of years. In fact, today, Google, before doing the share split of 20-1, at today's price would be worth $3,500 per share. Of course, they did a share split, so now it's $178 share split. So looking back, I realized that L&M at 3 cents was actually very expensive because the actual intrinsic value of L&M was actually close to 0 because the company was losing a lot of money. It was on the verge of bankruptcy. And at the same time, Google at $200 was really cheap because the intrinsic value was actually about $600, of which the share price went above that, and then the intrinsic value rose over time to now it's in fact a lot higher. In fact, I can tell you right now, Google is still dirt cheap. So there are two major mistakes that retail investors make in the markets. Mistake number one is looking at the absolute price and thinking that a low price means it's cheap and a high price means it's expensive. Wrong. Instead, you need to look at the intrinsic value of the stock, which I'm going to explain in a while how I calculate it and how I determine whether the share price is above the intrinsic value, expensive, or below the intrinsic value, cheap. The second big mistake investors make is by looking at a very simple metric like PE ratio to determine if a stock is cheap or expensive. Now, I actually made a video just on this. It's called The Truth About PE Ratios. If you have not watched that video, go watch that video after this video. But let me just summarize. So PE ratio is a very simple way to value a stock, but it can be oftentimes very misleading because PE ratio doesn't take into account the growth of the company and doesn't take into account the cash flow or the free cash flow generated, and only looks at the net profit, which sometimes can be just an accounting entry that can be very misleading. So using PE ratio to value a stock is like guessing a person's weight by looking at their shadow. and it can be very misleading. Sometimes you see a big shadow, but it's a skinny person from a certain angle. For example, a year and a half ago, in January 2022, Intel had a very low PE ratio of about 8 times earnings, and Nvidia had a PE ratio of 84 times earnings. And so people who look at PE ratio would have been misled. They would have thought, hey, this looks so cheap, buy Intel, right? This is so expensive, don't buy Nvidia, short Nvidia. If you had followed the PE ratio, you would have made the worst mistake in your life. Because if you actually do a proper valuation, which I'm going to teach you how to do in a short while, you would find that at 8 times PE, Intel was actually very expensive. Why? Because the earnings were not growing, the earnings were declining. And sure enough, if you bought it at $50 at the time, Intel would have dropped almost by 50% down to about $30 today. And if you bought Nvidia, at a point of time, Nvidia was selling at $300. By the way, I bought Nvidia at $150, right? So I was pretty lucky. I bought it much later than this actually. But anyway, even if you bought it at $300, today Nvidia, as of yesterday's close, after hours, is up to $1,000 per share. Because although PE of 84 times looks expensive, but it was actually not that expensive because Nvidia had huge growth potential. So what is the meaning of intrinsic value and how do we calculate it in the right way? So first, understand that when you buy a stock, you are buying a piece of a business. So you got to know what the business is worth and then divide it by the number of shares to know what each share is worth. So what is a business worth? Now, a business is actually a money-making machine. So the more money it makes, the more it is worth. Got it? So how do you know how much money this machine will make? So let me illustrate with an example over here. Let's imagine you have got a money-making machine. And this is a timeline I'm drawing. This is today. This is a year later. This is 2 years later. This is 3 years later. And let's imagine that this machine will print $100 today. Right here, right now. So can you tell me how much this machine is worth? If it prints $100 today, it's worth $100, right? Because if you buy it for $100, the machine gives you $100, you get back your money, okay? So the value of this machine, the intrinsic value is $100. Simple enough. What if I now told you that if you bought this machine, and this machine would print $100 only in a year. So 1 year from now, you get $100. So what is this machine worth? Is it worth $100? No, because you have to wait a year to get that $100. So it's worth less than $100 if you were to buy the machine today, correct? So what's the machine worth today? Well, it depends on the opportunity cost of your money. We call this the discount rate. So in other words, if you had the money to buy the machine, but you invested the money somewhere else with the same risk, what rate of return would you get? So let's say, for argument's sake, if you put your money somewhere else, you could get a 5% return. So that's your discount rate. So what you then do is you take $100, which you will get in a year, you divide it by 1 plus the discount rate, 1 plus 5%, okay? Which is equal to 100 divided by 1.05, that gives you $95. Ta-da! So in other words, this machine is worth $95, okay? Why? Because if you had $95 today and you invested it at 5%, you get $100 in a year's time. Next question. What if I had a money-making machine that I bought today, but it would print $100 in 2 years? So you wait 1 year, you wait 2 years, and boom, you get your $100. What is this machine worth? Is it worth $100? No, you got to wait 2 years to get your money. So it's worth less than $100 and worth less than $95. So to get the answer, you take $100 and divide it by again 1 plus the discount rate. But you have to discount it twice to get to today's value. So you got to square it, okay? So what is $100 divided by 1.05 squared? You get $91. So money received in the future is worth less than money received today. So whatever money we get in the future, we have to discount it by a discount rate to the present value. Okay, last question, I promise. So if I have a money-making machine that I buy today that's going to print $100 right now, and then another 100 in a year, and another 100 in 2 years, so I get 100, 100, 100, then what is this machine worth today? Well, this machine will be worth $100 plus 95 plus 91. So this machine, the intrinsic value of the machine will be $286 $286, right? So what has this got to do with investing in the stock of a business? Same thing. So for example, when you invest in shares of Meta Platforms, which is a business, you got to figure out in the next 10, 20 years, how much cash is the business going to generate? And you take all that future cash and you discount it to today's value, divide by the number of shares, and ta-da, you get the intrinsic value of Meta. And then you compare it to the share price. If the share price is above that, it's overvalued. If it's below that, it is undervalued.
So how do I actually calculate the intrinsic value of the entire business of Meta or Robinhood and calculate the intrinsic value per share? Well, I use this intrinsic value calculator that I developed many years ago. And of course, once you enroll in our Value Momentum Investing course, you can download this calculator. I'm going to show you how I input the figures right now. So let's begin by valuing Meta. So what are we trying to do? We're trying to figure out how much cash Meta will generate in the next 20 years. It's like the money-making machine generating cash for the next 20 years and then discounting all that future cash flow to the present value. Now, if you study for a CFA in finance, they teach you how to project a business cash flow to perpetuity using a terminal value. But I don't do that. I just assume the company will make money for 20 years and die. Right? So anything more than 20 years, it's a bonus. So I'm being very conservative here. So how much money is Meta making right now? Well, if you go on to Yahoo Finance, for example, you can see the last 12 months, Meta generated $49.518 billion in free cash flow. So we're going to use that to project into the future. So let's put that in. 49.518 million, which is $49.518 billion. So that is how much cash they are making in 1 year, all right? So how much cash will they make in the next 20 years? So we will project the growth rate over here. Now, what growth rate do we use? That's the tricky part. If you go to a website like Finviz, you can see that they are projecting Meta will be growing at about 30% annually for the next 5 years. 30% growth rate. Now, I'm going to be really conservative and divide it by half. It's always good to be conservative. So I'm going to assume that Meta is only going to grow at 15% for the next 5 years. And then after that, the following 5 years, the growth will slow down by half. So what's half of 15%? 7.5%. So that's the first 5 years of growth, the next 5 years, and the last 10 years, I'm just going to assume Meta is going to grow at 4%, which is slightly above the growth rate of the US economy. Okay? So that's how I put in these very conservative growth rates. Then I've also got to put in how much cash Meta has on their balance sheet right now. You can check that from the balance sheet. They've got $58 billion of cash. Then I put in how much debt they have. Short-term debt plus long-term debt from the balance sheet, they've got 18 billion in debt. So I put in all these numbers over there, and then I put in the number of shares that they have. Because what this calculator does is it's going to project all the future cash flow for the next 20 years. It's like the machine printing money for the next 20 years and then discounting everything to today's value and divide it by the number of shares to find out the intrinsic value per share. Now, what discount rate do we use? There are many ways to do it. For example, Warren Buffett uses the 10-year Treasury yield as his discount rate. In a CFA course, they'll teach you to use the weighted average cost of capital, but I use the cost of equity. So using this table over here, I check the beta of Meta is 1.2. That measures the volatility of the stock. And based on a 1.2 beta, that gives me a discount rate of 6.6%. So I punch that into the discount rate, and it will give me the intrinsic value of Meta. Here, there we are. So the final intrinsic value is $532. As of yesterday's closing price, Meta is selling at $467 per share. And you can see that at $467, Meta is still 12% undervalued. It is still cheap. So even though Meta has gone up from $80 to $467, it's gone up, let's see, it's gone up 400%, it's still cheap. And that is why I continue to hold Meta in my portfolio. So disclaimer, that's right, I'm still a shareholder of Meta, so I do have some vested interest, right? So you can see this account, I've got Meta, and I'm still holding it right here. It's up about, $84,000 in profits over there. And this other account, Meta, is up $88,000 in profits. Actually, I'm up a lot more than that, but I was stupid enough to sell some covered calls on Meta, so some of my shares got taken away. Damn it, right? But I still have a couple of shares left, which is not too bad. I still have about, let's see, $186,000 worth of Meta shares in this account and another $188,000 worth of Meta shares in my second account. So total is about $370,000 worth of Meta shares, which is, okay, a decent position. Now, how about Robinhood? So Robinhood looks really cheap based on its absolute price because it's now trading at, $19.66. And some people may say, whoa, it was at $84 once upon a time, looks really cheap. Could it get back up there? Now, do bear in mind that in the short term, market prices are driven purely by emotions and manipulation. So even a business that has got no intrinsic value, that is losing money, gonna die, the share price can go up because of hype and manipulation, because of some pussycat, right? Or Donald Trump's media company, where they're losing so much money, the share price could go up purely based on manipulation. But it is not sustainable. So as an investor, if you're looking to invest for the long run to build your wealth, then you don't want the price to just go up in the short term based on hype. You want it to go up and keep going up in the long run, all right? So that's when intrinsic value comes into play. So would I buy Robinhood at today's share price? Not that I think the hype is going to drive it up, but I think it's worth $19. Well, let's do a valuation. So the first thing to do is to take a look at how much cash Robinhood is making right now, and then we project it to the next 20 years and discount it to present value. So going to Yahoo Finance, you can see that for Robinhood, it's actually losing money. For the last 12 months, they actually had a negative free cash flow of $295 million. And so what happens? I mean, it's negative. We can't put in a negative figure, right? And you can see their free cash flow is very inconsistent. In 2020, it was, 1.8 billion, and then it was minus 968 million. Then it was minus 900 million. Then it was 1.16 billion. So it's like it's like all over the shop, right? They make money, they lose money, they make money, they lose money, right? So what do you do in a situation like that? So personally, the way I would value it in such a situation is to take the average free cash flow over the last 3 or 5 years. So if you take the average of the last 5 years, add all the 5 years together and divide by 5, you get an average free cash flow of $166.4 million. Okay, $166.4 million. So if we punch that into the intrinsic value calculator, 166.4 million, okay, and Robinhood has total debt of 4.2 billion in debt. They've got 4.7 billion in cash. Now, how about the growth of the company? What is the growth rate? Well, if you go to various websites, you notice there's no projected growth rate because the company is so inconsistent. There are no analysts that can make a decent projection. For example, if you go to Finviz, you can see that the next 5 years, sorry, that's Meta. Let's go to Robinhood. The next 5 years, the projection is undefined, right? But they are projected to grow at 5.97% next year. They can only project 1 year, but beyond that, they say we have got no freaking clue, okay? And if you go to another website, Guru Focus, you can see, again, they usually give a future growth rate, undefined. So we have no idea what the growth rate is, so inconsistent. So the only thing I can do is to put in the future revenue growth rate, which in this website, they define it as 17.6%. So being very optimistic, let's use 17.6% in the growth rate. So if we punch in 17.6%, and let's assume they can grow at 17.6% for the next 10 years, right? Let's put that in. And even with a 17% growth rate, their intrinsic value comes up to only $7. So at today's share price of $19, it is way overpriced. It's overpriced by 171%. And that is why I believe that Robinhood is actually expensive at today's price and Meta is actually cheap at today's price. Now, that does not mean that I can predict that Meta will go up the next day, the next week, or the next month, and Robinhood is going to go down the next day, the next week, the next month. No, remember, in the short term, anything can happen. In the short term, the market is driven by news, emotions, and manipulation. So sure, Robinhood could go up in the short term. Meta could go down in the long term. But in the long run, I rather hold Meta, which I know is undervalued now, than holding Robinhood over the long run. So I do hope you have found this video enlightening, and if you have, do give a thumbs up. So thank you for watching, and as always, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.